If you own a home anywhere in the southeast of England, or you've watched a modest three-bedroom house creep past £500,000 over the last 15 years, there's a number you need to know, because it hasn't moved once in that entire time. £325,000. That's the amount of an estate that can pass to your family for inheritance tax, and it's been frozen at exactly that figure since April 2009. Not increased with inflation, not adjusted for house prices, frozen, and the government has now confirmed it's staying frozen for years yet to come. Which means every single year, without a single new law being announced, without a single headline about a tax rise, more ordinary families who never thought of themselves as wealthy get quietly pulled into paying a tax that used to be for the genuinely rich. This isn't a loophole, it isn't a mistake, it's a deliberate feature of how the Treasury raises money without ever having to stand up and say they're raising your taxes, and it catches out families every single week who assumed their estate was too modest to matter. So today I want to walk you through exactly how this frozen threshold works, who it's already catching without them realizing, and the specific, legitimate steps you can look into to stop your family losing more of what you've spent a lifetime building than they need to. If you're enjoying this story so far, don't forget to hit the like button and subscribe. Drop a comment telling me where in the world you're watching from. I love hearing from you. Here's the mechanism, and it really is this simple. Every person in the UK has what's called a nil-rate band, and it's £325,000. Anything you leave behind up to that amount passes to your family with nothing owed to HMRC. Above it, the tax is charged at 40%. If you own a home and you're leaving it to your children or grandchildren, there's a second allowance on top called the Residence Nil-Rate Band, worth £175,000. Put the two together and a single person can pass on up to £500,000 before any tax is due. A married couple or civil partners can typically combine both of their allowances because whatever the first person doesn't use passes to the survivor, which in practice can mean up to £1 million passing to children with nothing owed. That's the headline figure, and on paper it still sounds generous. The trouble is what's happened around it. Back in 2009, the average house in England cost a good deal less than it does now. £325,000 covered most family homes with plenty of room to spare. Today, that same figure hasn't moved an inch, while the value of an ordinary home in large parts of the country has climbed well past it on its own, before you've even added a savings account, a pension pot, or the contents of the house. So the threshold isn't protecting the same families it used to. It's a line that used to sit comfortably above where most people's estates fell, and it now sits right in the middle of them. Let me give you a real shape of how this plays out, because the maths matters more than the concept. Take a couple I'll call Margaret and Alan, married for over 40 years, living in a house they bought decades ago for a fraction of what it's worth now. Alan passes away first and leaves everything to Margaret, which is exempt from inheritance tax regardless of the amount, because transfers between spouses are always free of the tax. Nothing is owed on his death, and because he used none of his own nil-rate band, it carries forward to Margaret. When Margaret later passes away, her estate now has two nil-rate bands available, hers and Alan's, worth £650,000 combined, plus both residents' nil-rate bands if the home goes to their children, worth another £350,000. That takes the couple's total tax-free threshold up to £1 million, which sounds like more than enough. But Margaret and Alan's house alone, bought decades ago, is now worth £650,000. Add a modest pension pot her husband left behind, some savings, and a small buy-to-let flat their son had been renting from them, and the estate comes to £1,150,000. That's £150,000 above the couple's combined threshold, taxed at 40%. A bill of £60,000, falling due within 6 months of Margaret's death, at a moment when her children are grieving and dealing with probate, not expecting to find a 5-figure sum owed to HMRC on a house their parents bought with nothing more than an ordinary income. Now here's the honest catch, and it's one that trips up a genuinely large number of families. That extra £175,000 residence allowance only applies under specific conditions, and it's worth knowing them before you assume it automatically applies to you. The property has to be one you've actually lived in as your home, not a second property or a buy-to-let. So Margaret and Alan's flat their son was renting wouldn't qualify for it, even though it added to the estate. And the home has to pass to a direct descendant, meaning children, stepchildren, or grandchildren. If you're leaving your house to a niece, a nephew, a sibling, or a close friend who's been like family to you for 30 years, that extra allowance simply doesn't apply, no matter how deserving they are. There's a further twist for larger estates too. Once an estate is worth more than £2 million, the residence allowance starts shrinking, losing £1 for every £2 above that mark, and it disappears completely once the estate passes roughly £2,350,000. So if you own a valuable property in a part of the country where prices have risen sharply, it's worth actually checking where your estate sits against that £2 million line, because the allowance you're counting on might not be there in full by the time it matters. There's another group this frozen threshold hits particularly hard, and it rarely gets talked about. If you're in a long-term relationship, but you've never married or registered a civil partnership, none of the spousal exemptions apply to you at all. It doesn't matter if you've lived together for 30 years, raised children together, and built a home together. In the eyes of inheritance tax law, you're treated as though you're strangers. Everything you leave to your partner above your own £325,000 threshold is taxed at the full 40%, with no transfer of unused allowance and no exemption for the size of the gift. Couples in this position are often the least prepared for a bill like this, simply because they've never had reason to think about it the way a married couple does. So what can genuinely be done about it? And this is where it's worth being precise, because there's a great deal of bad advice circulating about moving money and property around at the last minute. The most straightforward step for married couples and civil partners is making sure your wills are actually written to make full use of both nil-rate bands and both residence allowances when the second person passes away, because it isn't automatic. It depends on how the estate and the will are structured. Beyond that, there are legitimate ways to reduce what falls into your estate over time. You can give away £3,000 a year, completely free of inheritance tax, and if you didn't use last year's allowance, you can carry it forward once, meaning £6,000 in a single year. Small gifts of up to £250 per person, wedding gifts of up to £5,000 for a child, and regular gifts made out of genuine surplus income, money you don't need for your own living costs, are all exempt too. Larger gifts, money or property given away outright, can also fall outside your estate entirely, but only if you survive 7 years after making them. Die within 3 years of a gift above your nil-rate band, and the full 40% applies. Die between 3 and 7 years afterwards, and the tax on that gift tapers down in stages. 20% relief in year 3 to 4, rising to 80% relief by year 6 to 7. There's one trap here that catches people every single year, and it's worth saying plainly. If you give your house to your children, but carry on living in it without paying a proper market rent, HMRC treats as though you never gave it away at all. That's called a gift with reservation of benefit, and it undoes the whole point of the gift. This isn't something to attempt on your own from a kitchen table conversation. It's exactly the kind of decision worth taking to a solicitor or a regulated financial advisor before you act, because getting the structure wrong can cost a family far more than doing nothing at all. If you're hooked on this story, make sure to subscribe and turn on notifications so you never miss an upload. Your support means everything and helps me bring you more emotional stories like this one. There are 2 further changes worth knowing about, because they widen who this frozen threshold catches even further. From April 2026, the rules around business and agricultural property relief have tightened. Previously, A family farm or a family business could often be passed down through generations with no inheritance tax at all, however large it had grown. Now, the full 100% relief only applies to the first £1 million of combined business and agricultural assets per person. Above that figure, only 50% relief applies, which in practice means an effective rate of 20% on the value above the threshold. For a family running a working farm, where the land itself can easily be worth several £1 million, even though the actual income it produces is modest, this is a genuinely significant shift, and it's turned estate planning from an afterthought into an urgent conversation for a great many farming families who never expected to owe inheritance tax at all. The second change is arriving from April 2027, and it affects a much wider group of people. At the moment, most private pensions, including SIPPs and defined contribution pots, sit outside your estate entirely for inheritance tax purposes. From April 2027, most inherited pension funds will be brought inside the tax net for the first time. For anyone who has spent years deliberately keeping money in a pension rather than a savings account, specifically because pensions sat outside inheritance tax, this changes the calculation considerably, and it's worth reviewing who you've nominated as your pension beneficiary and how that fits with the rest of your estate well before the change takes effect, rather than after. The single biggest mistake I see people make with all of this is assuming that because everything passes to a spouse tax-free, there's nothing to plan for. It's true that the first death, in almost every case, produces no inheritance tax bill at all when everything goes to a husband, wife, or civil partner. But that isn't the end of the story. It's a postponement of it. The whole combined estate, the house, the pensions, the savings, the investments, gets assessed together on the second death, against thresholds that have been frozen since 2009 and are staying frozen for years yet. Families who never gave inheritance tax a second thought during the first death are often the ones most caught out during the second, precisely because nobody looked at the combined picture while there was still time to plan around it. So here's what's worth doing, practically. Add up what your estate is actually worth today, the house at its current value, not what you paid for it, along with savings, investments, and pension pots, and see where that figure sits against £325,000, or £500,000 if a qualifying home is going to direct descendants, or £1 million if you're a married couple planning to use both allowances properly. Check that your will is actually structured to make full use of both nil-rate bands and both residence allowances on the second death, because it doesn't happen automatically just because you're married. If you're in a long-term relationship without being married, or in a civil partnership, understand clearly that none of the spousal exemptions apply to you, and plan accordingly. If you're thinking about gifting money or property to reduce a future bill, understand the 7-year rule and the reservation of benefit trap before you act, and take that specific question to a solicitor or a regulated financial advisor rather than guessing. And if you run a farm or a family business, or you're relying on a pension pot to pass tax-free to your children, look into the April 2026 and April 2027 changes specifically, because both shift the ground under decisions that used to be settled. Let me bring it all together. The £325,000 nil-rate band and the £175,000 residence allowance have been frozen for years and are staying frozen, while property values keep climbing, which means more ordinary families are being pulled into inheritance tax every year without becoming any wealthier at all. Married couples can often combine their allowances to shelter up to £1 million, but only if their wills are actually structured to make use of it. The residence allowance only applies to a home you've lived in, left to direct descendants, and it shrinks away entirely for larger estates over £2 million. Unmarried couples get none of the spousal protections at all. Gifting can reduce a future bill, but only if you understand the 7-year rule and avoid the reservation of benefit trap. And changes arriving in 2026 and 2027 are bringing family farms, businesses and pensions into scope in ways they never were before. None of this is a reason to panic, but it is a very good reason to actually check where your family's estate stands today, rather than assuming the rules that applied to your parents' generation still protect yours. Now, before I go, the usual and important word. I spent my working life in and around money and tax, but I'm not your personal financial advisor, and nothing I've said today is personal advice for your particular situation. Estates, wills, and family circumstances all differ, and the exact figures and reliefs do change, so it's always worth checking the current position on gov.uk or speaking with a regulated solicitor or financial advisor before making any decisions. The good news is, there's free, impartial help available too. Money Helper can point you toward regulated advice, and Citizens Advice can help you understand your own situation without cost. There's a strategy that solicitors mention constantly and almost nobody outside the profession has heard of, and it's worth explaining properly because it can turn a nasty six-figure bill into something a family can actually manage without selling the house. It's called a whole-of-life insurance policy written in trust. Here's the idea in plain terms. Instead of trying to shrink your estate to dodge the tax altogether, you take out a policy that guarantees a payout on your death, sized to roughly match whatever inheritance tax bill your estate is expected to generate. Crucially, the policy has to be written in trust, which simply means it's set up so the payout goes straight to your beneficiaries rather than into your estate first. If it lands in your estate, it just becomes part of the taxable pot and achieves nothing. Written correctly, the money arrives with your family within weeks, completely outside probate, and it's specifically there to settle the tax bill, so nobody has to rush the house onto the market at a bad price just to raise cash within that 6-month deadline. Premiums for these policies climb with age, so this is a strategy that rewards people who set it up in their 50s or 60s rather than waiting until their 80s. Then there's a lever almost nobody in a family conversation ever raises voluntarily: charitable giving. If you leave at least 10% of your net estate to charity in your will, the rate charged on the rest of your taxable estate drops from 40% to 36%. For a large enough estate, the maths can work out surprisingly close to neutral, meaning a meaningful gift to a cause you care about costs the family far less than the headline percentage suggests, because you're giving away money that would otherwise have gone to the Treasury anyway, rather than money that would have gone to your children. There's also a tool called a deed of variation, and it's one of the few pieces of estate planning you can still do after someone has died, which surprises most people. Within 2 years of a death, beneficiaries can agree to redirect some of what they've inherited, whether to skip a generation and pass assets straight to grandchildren, or to route a portion to charity, and have it treated for tax purposes as though the deceased had left it that way in the first place. It requires everyone affected to agree in writing, and it isn't something to rely on as a backup plan instead of a proper will, but it has genuinely rescued families who discovered the tax exposure only after it was too late to plan in advance. None of these replace a conversation with a solicitor, and none of them work well bolted on at the last minute. But between a trust-based insurance policy, a charitable gift that softens the rate, and a deed of variation as a safety net, families have more room to maneuver than the frozen threshold alone would suggest. Thank you so much for watching until the end. If you loved this story, check out the other videos on your screen now. I think you'll really enjoy them. And don't forget to subscribe if you haven't already. See you in the next story.